So you want to start investing in the US market, right? Sooner or later, you're going to hit a wall. It's not about what to buy, it's about how. That how is a trading account, or what's more commonly called a brokerage account. It is the absolute first step, your personal key to the financial markets. So let's break down exactly what that means. Okay, so you've done your homework, you've got some cash set aside, and you've decided, all right, I'm ready. I want to invest, which is awesome. That's a fantastic first step. But then you run smack into the first very real hurdle. How do you actually go out and buy a share of a company? I mean, you can't just call up the New York Stock Exchange, right? There's a crucial middleman you need. And that is where a brokerage account comes in. This is it. This is your personal gateway to the financial markets. It's really just an account you open up with a licensed company that lets you put money in, buy things like stocks and ETFs, and then hold them securely. Without one of these, you're basically just watching from the sidelines. Probably the easiest way to wrap your head around this is to think of it just like your bank's checking account. Seriously, you put money in, but instead of using that money to buy groceries or pay bills, you use it to buy and hold investments. That's the core idea right there. Simple. Okay, so we get what it is, but what does the process actually look like from start to finish? Let's walk through the practical journey of going from having cash in the bank to actually becoming an investor. It's probably a lot more straightforward than you think. The whole thing really just breaks down into 5 pretty simple steps. First, you apply for an account online with a brokerage firm. Once you're approved, you fund it by just transferring money from your regular bank account. Then the fun part, you log in and place the trade, an order to buy some shares. The broker then executes that trade for you out in the market. And finally, you get to monitor how everything's doing right there on their platform. That's it. That's the whole shebang. Now, once you decide you're ready to open an account, you're going to face a couple of choices right away. And this is where it really pays to understand your options. It all pretty much boils down to answering 2 big questions about what you want this account to do for you. And here are those 2 fundamental questions. First, how will your money be taxed? This is all about the function of the account. Is this for general investing, or is it for something specific like retirement way down the road? And second, how are you going to fund your trades? This is about the method. Are you only using the cash you've put in, or are you maybe thinking about borrowing from your broker? Let's break them both down. So your first big choice is all about taxes. On one hand, you have a standard taxable brokerage account. This one gives you the most flexibility. You can put money in, take it out, no big deal. But you'll have to pay taxes on your investment gains every year. On the other hand, you have a tax-advantaged account, like an IRA. These are built specifically for retirement, so they come with stricter rules. But in return for following those rules, you get some pretty powerful tax breaks. It's really a choice between flexibility now versus tax benefits later. Your second choice is about funding your trades. The cash account is the most straightforward, basic, and safest option. You can only invest with the money that you've actually put into the account. Simple. Then there's the margin account. Now, this is a more advanced tool. This is where your broker actually lends you money to trade, using your investments as collateral. And while, that can juice up your potential profits, you have to understand it also dramatically juices up your potential losses. Now, speaking of those risks with a margin account, I want this number to stick in your head. $25,000. This isn't just some random figure. For certain types of very active traders, this is a critical legal line in the sand. So why this number? Well, the main regulatory body, FINRA, has a special rule. If you make a bunch of trades in a short amount of time, we're talking 4 or more day trades within 5 business days in your margin account, they label you a pattern day trader. And if that happens, you are legally required to keep a minimum of $25,000 in your account at all times. It's a rule designed to make sure only people with a serious amount of capital are taking on that kind of serious risk. Hearing about all these rules might sound a little intimidating, but they're actually there for a really good reason, to protect you, the investor. So let's talk for a second about who exactly is looking out for you and making sure the whole system is on the level. First up, you've got FINRA, the Financial Industry Regulatory Authority. Think of them as the main referee on the field for all the U.S. brokerage firms. They write the rulebook, including that pattern day trader rule, and they enforce it to make sure the game is being played fairly and that investors are protected. And then there's SIPC, the Securities Investor Protection Corporation. This is another huge layer of protection. It's basically insurance for your brokerage account. But, and this is a really big but, you have to know exactly what it does and what it doesn't cover. A lot of people get this wrong. Okay, let's get this straight because it's super important. SIPC protects you if your brokerage firm fails, like if it goes bankrupt and your cash and securities are at risk. In that worst-case scenario, your account is insured for up to $500,000. But, and I can't stress this enough, SIPC does not protect you from making a bad investment. If you buy a stock and its price goes to zero, that's on you. That's market risk, and SIPC doesn't cover that. All right, so let's tie this all together. What are the big takeaways here? First, a brokerage account isn't optional. It is your essential gateway to investing. Second, getting started is a simple 5-step process. Open, fund, trade, execute, and monitor. Third, your biggest choices right out of the gate are deciding between taxable versus tax-advantaged and cash versus margin. And finally, remember that while regulators and insurers are there to protect you from things like fraud or a firm failing, they absolutely do not protect you from market risk. So, in the end, a brokerage account isn't really the destination, is it? It's just the tool, it's the workshop, and you've just been handed the keys. So the real question is, now that you know what it is and how to use it, what are you going to build? Thanks for joining me for this explainer.